Good afternoon, this is Brad Dennis with BIS Commodities with your wrap-up for the first week of 2015. A lot of market movement this week with little conviction. First, let's start out with the equities, and the two big movement makers out there or events were first the FOMC minutes and then the unemployment results that we saw today. FOMC minutes revealed that we're still on track for a rate hike in 2015. Now that's the majority of the members of the Fed. Today we did hear of Evans, one of the Fed members, come out and say that he's not ready to vote for rate hikes until 2016, citing that there has to be inflation out there before you can do it. But he's kind of the lone dissenter that we're looking at right now. So the majority are looking for rates still around that June time frame. And with that possible rate hike, we're still looking at the dollar index continuing to make higher highs, higher lows on a weekly basis. Unemployment numbers came out today. They beat estimates. Non-farm payrolls were a little bit higher than estimates. Unemployment rate went down to 5.6%, and private payrolls were up 240. People were estimating 238, so positive there. Now the participation number did go down once again, and that probably accounts for that 5.6 unemployment number, but as long as we're still creating jobs out there, that's going to be looked at as positive. And there was nothing in this report that would tell the Fed to back off on their ideas of hiking interest rates down the road. Over in the cattle market, wide swings this week when you look at where the futures are and where cash traded. Cash traded 170 and higher on Tuesday, and then after that it was all she wrote, and we saw futures come down to, I believe Feb's traded down to 160.60 today. Boxes were higher for the week. They're trying to get that cash price up there, but reality is that we just had a few traded. A lot of these packers are still waiting for delivery in the second week of December on cattle that they bought last month, so the numbers were down on what they purchased. But one of the big things that we're seeing also is that you're seeing an index rebalancing coming through here. And with the strength in the cattle futures being such a high percentage of that index now, they have to sell out of that position or have to pare it back some. And that's mostly to blame for this price coming off in the cattle market. I mean, right now, if you have cattle out there and you need to sell it and it's hedged, it's ideal to be able to sell 168, 170s and buy it back at 161 on the board. It's a hedger's dream, so to speak. Will that happen? You got to get the cash sold first. We know you can buy it back on the board, but you got to get that cash sold first. So it's kind of an interesting development. We'll see if the futures are going to lead the cash cattle market down a little bit here. I'm sure packers would like to see that, seeing as they're operating in the red pretty much this whole week. Moving over from cattle to the energies. Energies are still trending lower. We still have lower lows, lower highs. Trying to find a bottom out there, and where that is, everybody's saying 45, or they were saying $50. Well, once we broke 50, then it was 45. Once we break 45, maybe it's 35. Nobody really knows, and it's kind of like catching a falling knife right now. There'll be some bottom pickers out there, but it really seems like the momentum is still to the downside. And don't forget that that higher dollar is going to continue to cause that trend to be down. Now, when you look at the lower crude oil prices too, you have to think, all right, a little bit of conspiracy out there. Who who benefits from it? Well, the consumer does. And who's it a big negative to? Well, unfortunately, it is to the energy companies, which are now that we don't import as much crude, we're kind of shooting ourselves in the foot, and that's kind of taking a little bit off on the equities a little bit. But for the most part, the consumer has more buying power, and that's a positive out there. At some point, it'll find some kind of stability. We just haven't gotten to that place yet. Over in the grains, start out with corn. Corn going into today was only down a penny on the week, and today we saw it close up 5 to 6 cents. A couple things we're trying to boost it up, and these were just short-term things that popped up. One, we heard of a shipment off the PNW of corn for China. Now, most people think that that'll end up in Japan, but there is a ship that's going to load to go to China on the manifest there. And also there was a large commercial out that was talking about possible yield cut on Monday's supply and demand report. So those two things kind of got things a little bit excited, and it seems like this corn market is a lot about short-term, especially the bean market too, is about these headlines that come out and boom, everybody goes through it, and they kind of forget about the big picture. And you got to step back a little bit, and you got to look at the big picture for what we're looking at, and you can't ignore that energy prices are more than half of what they were 2 months ago. You can't help but realize that with the most recent rise in corn, that indexes will be rebalancing and selling out their corn position, not adding to them. You can't deny the fact that people that have been in not hedge funds so much, but in commodity funds over the last 3 years have been losing money, so there's got to be some kind of redemptions going on out there. And also you have to look at what we saw this week from Informa, which is an analyst out there, talking about production numbers. Their production numbers are still above what the USDA had last month. So they're not at all talking about the FSA data having to move acres down, and I think people are kind of stepping away from that bullish excuse, knowing that that FSA data is, one, incomplete, and two, is not fully, the participation there isn't full enough to go directly off of that data. So NASA will probably use their own data on that one from satellite imagery and surveys, I would imagine. So, I mean, those are the kind of long-term things that, yeah, we're up at this place, and just like today, hey, we're up 5-6 cents because, oh, maybe we're loading up a ship to go over to Asia. But that's a short-term thing. Think about where ethanol's margins are going. Crude ended up lower again this week. So, I mean, those are some underlying items that'll kind of keep a heaviness to the market, I would imagine. Over in the beans had a great week, up 40 cents. Went down to $10. China bought a bunch of beans. Boom, we came up to the higher end of the range, 1060. And we're just slightly off of that 1060 area. Now, once again, what are the excuses to get up here? Well, we did see good demand out of China. They continue to buy, and that's a great thing. We want somebody to buy these beans. Two, there was a lot of talk about possible dryness in northern Brazil. Well, you got to step back on that one, because today we had CONAB, which is basically the USDA out of Brazil, come in and up both their estimates for corn and bean production. So they're the people down on the ground there. They're the ones that are looking at it, and they're saying, hey, it's not that big of a deal. I'd almost say that I'm more concerned with wetness in Argentina, but we'll see how that plays out. Nevertheless, on Monday when we come in here and we see some numbers, we're probably going to see the most amount of beans ever in the world, and that's just going to be something that just kind of hangs over this market. I think a lot of people remember when we were going through our growing season with beans, and we were hanging around 1250 or so in the beans, and everybody was saying, hey, this is a great crop, this is a great crop. Why doesn't it break? Well, we finally did break it down to 920. Now we're back up to 1050, and we're kind of hanging around this area, and we're hearing about this great crop down in South America. Maybe we need to get some more harvests going on there to see this market back off some, because with the amount of beans that you have in carryout and potential carryout for next year, it's going to be a sizable amount. So that kind of takes us into what happened this week. What do we have to look at next week? Well, next week is going to be Monday at 11 o'clock, the USDA S&D report. And that's really going to determine the tone for the rest of the day. I think what you're seeing right now is corn's factoring in a carryout below the average analyst. Let's see here. Average analysts are looking at corn carryout to be 1.927. I think they're trading a number under that 1.9, maybe 1.8. Over in beans, they're looking at carryout going under 400. So that's where 400 million. So that's where we're seeing a little bit of this bullishness coming into this report. Other news that'll be coming out there is final production data. Most analysts have us losing 1/10 of a bushel in yield on corn from 173.4 going down to 173.3. In the beans, though, going up from 47.5 to 47.6. So we'll see how that develops there. You're still looking at corn output over 14 billion in bushels out there, and close to 4 billion in beans. So that's kind of where we're at. We're going to be looking really closely at that number. The other thing, too, is we're going to look at our quarterly stocks. And last year, I think we lost about 200 million in quarterly stocks in this report. Whereas this week, I think there's a good enough argument to say that we might find those 200 million bushels up there. So I view this report having, I don't know what they're going to say, but the potential for the higher prices, yes, we might shoot up there for a little bit if it is a bullish report, but make sure that it is bullish enough and not just slightly bullish, because I think that that's already factored in there. So we'll see what the government has to say, and we'll go from there. End of broadcast.